have to say the biggest power brokers we've seen over the past few weeks didn't come from the world of tech at all. They came from the world of retail. I keep going back to that meeting several Mondays ago in Washington, D.C. between the biggest retailers in this country and the President of the United States, which many people believe led to the truce we saw over the weekend.
And the threat of empty shelves heading into the back-to-the-school season. And we just heard from Gene Soroka that still is a question mark as companies try to figure out the new landscape that they're trying to order in. The fact that Walmart's CFO is saying that price hikes from tariffs may start this month, this coming out in news reports right now, gives you a sense of the pressures that are going to be building at a time where even though tariff rates have come down from some of the worst-case scenarios, they still are materially higher than where they were at the start of the year.
That's a warning from Walmart this morning. Here's the view on Wall Street. Jim Zelter, the president of Apollo Global Management, weighing in on the administration's trade regime the last time he joined us, saying this: globalization is not going to be like we have seen it in the past. It is a new global world order. I'm pleased to say for the next 30 minutes, Jim Zelter joins us this morning. Jim, good morning.
Good morning.
There's a phrase you used last time around that stuck with both of us. We've been repeating it over the last several weeks: macro paralysis. Can you adjust that term now? What phrase would you use to describe this moment?
First of all, it was good to be here. I think I would frame it right now as a macro political pivot. The administration, clearly, I agree. I think that Monday meeting with the retail executives was I don't want to call it watershed, but it was a critical moment for the administration to hear about the challenges on the ground of their plan. And the administration certainly has not admitted they made a mistake, but they've clearly pivoted. And that's not a surprise, and it's not a surprise that they're out going around the globe right now trying to and successfully inking a lot of deals, a lot of MOUs that are non-binding, but certainly it's great headlines, and it's hundreds of billions, if not trillions. But so that's where I think the big question now is, I'll pull back in the COVID library. There's a big gap between confidence, sentiment, and the results. And confidence and sentiment is still pretty negative or concerned, but the results have been pretty strong. And so there's a very, if you think about, we're all, history of the past, and we see signs of what we've seen in the past, and pattern recognition, if you will. And, if you input all the things that you see right now, you would have been saying recession went from 30% to 70, 80%. Now it's probably below 50%. But the three questions are: does the consumer, do corporates and countries, are they going to be on the V-shaped recovery, the U-shaped recovery, or the L-shaped recovery? Our view at Apollo is right now that the consumer is still pretty strong, a bit of a V-shaped recovery. Corporate's a bit of a U-shaped recovery because a lot of CapEx. And I've been traveling around quite a bit, and I think the global response is a bit more like the L. And what you pointed out earlier, what Anne-Marie did with Tim Cook, I am not surprised. None of us should be surprised that this administration is going to put their arm around all of these tech titans and other leaders and saying, come to America. China was not the plan. We didn't love the idea of going to India. Come back to the U.S. This is going to be a theme that they're going to keep hitting.
Is there enough of a framework that you're gleaning from this administration that's solid to bring deal-making back? We've seen on the margins some deals being made, some IPOs. There are just a few. Is this the beginning?
Well, I think let's separate the headlines from activity. It's been an incredibly active time for folks that have been involved in the markets. We at Apollo, we opened up the IPO market. We brought out Aspen, one of our reinsurers, for an IPO. We did a multi-billion-dollar deal for Lottomatica, IGT Every. We announced a big merger between New Home and a Land and Sea. So there's been a lot of transactions since April 2nd. I know the headlines may show contrary, but there's been a tremendous amount of financing, and I think it shows the depth and breadth of the markets right now because of private capital in the equity and the credit world. So this idea that the market shut down, that's actually what happened 2 decades ago. 2 decades ago, the high yield market would go into periods 6, 8, 10 weeks where there would be no issuance based on the flows from retail, the old AMG numbers. So this economy, this capital markets is very robust. Obviously, a lot of volatility. One of the benchmarks in our market would be HYG, the high yield index, the listed HYG ETF. That went from basically 79.80 down to 73, 74, back to 79. It's been a round trip, but there's been a tremendous amount of activity underneath the headlines.
How much do you think this is because people see the environment as being brighter than some may worry? And how much do you see this as just simply pent-up demand that's been backed up for a long time? There is this sort of cyclical move toward industrialization, and you have that kind of fundraising that is kind of independent of any economic cycle.
I think the bigger long-term trends of massive CapEx, the year or two of CapEx, global industrial renaissance, the demographics, every asset class is higher today as we sit here this morning than it was on Liberation Day, except for treasuries, which have 10-year basically 30 basis points higher, and the 30-year about 40 basis points higher, about 5.50 and 6% respectively. That's telling you that folks think that the economic backdrop is not going to be a recession. It's going to be slow to moderate growth, and that's what you're seeing right now in the market. So that's what we're seeing from our companies. We're seeing a lot of concern, a lot of hand-wringing about big strategic M&A transactions. I don't think you're going to see a massive equity calendar except for a few large deals here and there. But the reality is companies need to operate, finance, and grow, and they're positioning themselves for an environment that the administration's putting forth.
This is what companies need. Let's spend some time talking about what investors need. Never mind the rebound. What did you learn from the drawdown, public versus private?
Well, what you saw is that I come up here a lot and talk about market structure, and what you're finding right now is that longer dated capital, is us and many of our peers have long dated insurance assets. Those were the folks that were the most active during the marketplace, and they were a bit of the buffer, if you would. You know, we put about $27 billion to work in the IG market from April 2nd to last week. That's on a growth basis about 17, 18 billion. I think in the past, that participant was not in the market as much, and the buffer from the Wall Street bank trading desk taking that balance, I think that we collectively as an industry helped out. So you didn't see as much volatility. There's a lot of cash on the sidelines. There's a tremendous amount, and again, as you see what's going on right now around the globe with, you know, the pension assets, DC assets, other assets, really trying to get long duration assets against their liabilities, it's really, really critical. I mean, the one big overhang that's still in the market is what's going on in the Treasury market. You know, certainly if you pivot right now to what's going on with the budget issues in DC, it doesn't look like they have a clear path to a deal that would be really deleveraging to the U.S. over time. Now, Bessent is saying a lot of great things, but Treasury rates are higher, and you know, as we've been saying, the one real left tail risk for this administration is the Liz Truss moment. Is that still out there? It's not a zero. It's not a big number, but it's a left tail risk for this administration.
Can we ask you what you think that looks like? What does a Liz Truss moment look like in the Treasury market?
You know, it's the deepest, most liquid, broadest market in the world, and I don't really participate day to day, so I'm not. It really is. It's a confidence issue, and it's when that stream of confidence goes from not being substantial to being a little bit more material, and I don't know what that number is, but certainly it's got to be in the back of the head of the administration. And again, the prior administration did not really extend duration in their liabilities. So there's I don't know if it's 7 or 9 trillion of refinancing over the next 24 months. It's a big number. But these rates are real. Rates are real in terms of where they are right now. So you are finding buyers of that paper, but it is a challenge in the backdrop.
There is this belief that private credit markets offer this ballast, this sort of haven from some of the volatility that we're seeing in public markets, and in particular from the Treasury market. At the same time, how can you say that private debt in particular is really immune to the fluctuations and the sucking sound of capital into the Treasury market, given all of that issuance?
Well, I'd say two things, and this is a longer conversation that I do want to get into. Real rates are higher, and if you can in private credit, you know, high single digits, low double digits on a compounding basis, it's a tremendous asset class over a decade or two. I really want to spend some time with you both this morning talking about, you know, these comments about private credit being a bubble. You know, that's just a mistaken comment, and when you really break it down, as I said before, private credit in the traditional manner, the narrow manner, is the high yield market, the leveraged loan market, and now the emerging direct lending market. When people talk about a credit bubble, it's just not the case. What they are talking about is there could be a credit cycle. That's normal. We haven't had one in a long time, but that credit cycle will impact debt and leveraged balance sheets, high yield, leveraged loans, and direct lending. It'll also affect private equity. It'll affect equity multiples, but it's not a bubble per se. It's a good old recession and a credit cycle. We're going to have one of those. It may be pushed out again a year or two, but let's not go out there. I think folks that are not in private credit or private capital say, oh, it's a bubble because they're not involved. But the reality is there's lots of opportunities. There's a massive amount of opportunities. We were very active last month. Boeing decided to spin off its aircraft, one of its businesses. We worked in conjunction with Citi on it. Multi-billion-dollar deal, a tremendous asset, heated auction. There's opportunities for real companies, but there will be a credit cycle.
Still with us, Jim Zelter of Apollo Global Management. Jim, we talked about the prospect of a credit cycle. How can we have a credit cycle when we're running deficits this large in Washington?
Well, I mean, as I said before, we've been waiting for those who have been professionals in this sector for decades would have expected a few things right now. And I've talked about pattern recognition. I was here several years ago talking about the rate hike and how that would create a period of tighter financial conditions. And many of us that were expecting a serious credit cycle, predicted something that didn't occur because of the macro backdrop. Certainly right now as we have a higher rate environment, which means a bit of economic strength in the overall economy, there always are a number of companies that just have too much leverage and are not going to grow out of their balance sheets. And you're going to see that. Last couple of years, you had actually fairly high numbers of restructurings in non-investment grade credit. It just didn't overwhelm the headlines because of the overall returns and the strength of the equity market. But I do think there are, as I said before here, when you look back at the last 4 or 5 years in private credit direct lending, a lot of the largest sector of financing was technology and enterprise software. And I do think that there's a possibility with what's going on with AI that many of these companies could really have massive impact on their operating business. The renewal rates that are 80, 90, 95% could plummet dramatically. And I could see a variety of challenges in the enterprise software tech space that have been a big area of private credit. And I think there will be those who are not involved will say, aha, there was a problem, it's a hoax. That's not the case. It was just bad companies, over-levered, that didn't grow out of their balance sheet. And that happens every day in the equity market and other markets. But, as much as we are a player in the insurance balance sheets on safe yield, we also do play in that riskier end. And I don't see a massive credit cycle happening in 25. Certainly, we've taken care of a lot of the refinancing risks. That refinancing cliff that was pretty large in 26 and 27, it's been pushed out. But we're not seeing, although the risk premiums have been raised. And I will tell you, there's a very large U.S.-based retailer based here in New York that has undergone a transformational merger. They had a private credit solution in front of them, which we were quite involved with. They decided to go to the public markets and issue a public bond in the safe public markets. And that bond today, within 6 months, is trading below 50. So again, I think there's a lot of noise about risk and reward in various asset classes, but that's our view of private credit.
Just quickly, how much could higher long-term U.S. yields spur that credit cycle? I won't call it a bubble because we could talk about what a bubble is or what what we could see with some sort of just negative price action. But do you see that as being a catalyst?
Well, I think that the overall, having higher real rates are good for long-term investors to a certain degree. They're good for a certain degree until we lose confidence in the actual underlying market. And again, the U.S. Treasury market, deepest, most liquid in the world, rates of 4.5% and 5% with real rates right now, pretty strong on a relative basis over the last 25 years. But I'm not seeing that in the current zip code.
Just to wrap it up, biggest opportunity right now for you and the team, what do you think it is?
Well, I think it's a few places. I do think the volatility that has taken most people on the sidelines in a bit of a paralysis, just operating day in and day out on the business that we do right now. We have $850 billion of capital, doing a lot of refinancing with PE firms. There's over 2,000 PE situations where they've owned companies more than 5 years. A lot of refinancing there. Listen, the global industrial renaissance is alive and well in the U.S. with the delay in deploying the CHIPS Act, a lot of financing onshore of chip manufacturing and other assets. I've been traveling around the globe quite a bit. Japan's still quite interesting from a insurance perspective, from a global wealth perspective, and a PE perspective. And we cannot forget about Europe. I mean, Europe really is what's going on there. It's a once in a generation. I do believe that there's a variety. When you look at a 30 trillion economy in the U.S., 24 trillion in Europe, there's a massive amount of financing to occur.
You've been traveling too much. It's good to have you back.
Good to be back.
Welcome back to New York, Jim Zelter of Apollo Global Management. Jim, thank you, sir.